This week had a lot of things that shifted and presenting a lot of opportunity going into next week. So we're just going to hop right into it. From the margin interest to 6 names that were moved in and out of the Nasdaq. There's a lot to come. I think the most important thing for me looking at this weekly S&P 500, just to start, the most significant thing for me is just this kind of pattern. I'm huge with pattern recognition. Up, down, up, 1, 2, 3. This bar is what we get. We kind of feel like we're out of the woods a little bit. I don't know if that's the case, and we're going to talk about it, at least on the short term. I don't really like when you have like 2 dojis just sitting up here staring at one another, and I'll show you why. When we drop this down to the hourly and we mark it off, and we can see that level from here, which is that November, we have a new president kind of move out of here that we've retested. And we see it right there, right? Bonk, rallies, bonk. Okay, so we flipped from resistance to what? We can all see that we flipped here, okay? So what does that do for us? It gives us a level, demarcation line. Now you can see it becomes support, tries to rally, and then what we do there is just drop another line, yay. Tries again, comes back down, again, down, again. In between all this, you have economic data that came out, and you know how much I love economic data and marking off those control bars. So if we look at this then, from that weekly, and the devil's always in the details, and just say, okay, well, give me these lines. Well, right here is that CPI release. And we always mark off these bars, right? Drop it down to a 5, and then you can watch your entire life for the day play out on these bars. It's kind of crazy, but the algorithms and the high frequency traders are kind enough to tell you exactly where they are, even though people think that, it's a bad thing to have the high frequency traders. They're not the brightest. There they are right there, and you can see there, and you can even see it if we went back to, I believe what we had here was that Friday 8:30, and you just mark off those non-farm payroll numbers, and you can see this over and over again. And if you watch these videos, you know how much I love these levels, because they just tell you exactly where they are and where they're selling. So when they get back to there, you're not shocked by it like everybody else is. Like, that would not be shocking that it had an issue there at 2 o'clock in the morning, or that you had an issue here at 1:30 in the afternoon. That would not have shocked you, right? You would have known that that is an area of interest. So tries to rally, can't, comes back down off that non-farm high, and here we are. And then from there, it just keeps on rolling with the hits. Now, Thursday was interesting. And Thursday was interesting because of what? The PPI number was higher than expected. And what's important about that is, I feel like that's off. Do you feel like that's off? Because we're not going to have time to edit and make do. And there you go. Yay. So what do we have here that's important? Well, when corporate profits, CPI, what we buy as a consumer for the burrito, right, versus what they need to make the burrito, PPI is the producer, CPI is the consumer. So in between here, you have corporate profits. And just think about it that way. PPI is what they buy the goods for. This is what they sell the goods for. In between those two numbers is corporate profit. If this is dropping and this is rising, corporate profits go down, right? Just the way that it is. So when you understand that, and we're not going to get into all of it today, but your life gets a little easier because then you understand and go, oh, that's why he marks off these levels. And that's why equities never got higher than his 830 level, right? Wink, wink, nudge, nudge. So then that level there, okay? And then you can kind of see how we battled what? CPI level. I mean, it's not rocket science, guys. When you start knowing what to actually look for, right? Your life will get a lot easier. Down, retest, end of the week, people throwing in the towel saying, that's it, I've had enough. So if we take a look at this, we're not shocked by these moves because we understand why we're moving. Remember how I look at the world. Everything is macro. Then we have the fundamental side of the market, and then we have the technical side of the market. And that gives us what? That gives us our stool. And then that tells us a pretty long stool. We could share that stool. And then what we could do is sit at the bar, but probably not with something that big. I mean, that would be ridiculous. And then what you're doing is you sit at the bar. Sometimes you're leaning on the macro. Sometimes you're leaning on the technical. But what doesn't change is the what of the macro, the who of the fundamentals that's affected by the what, and then the technicals, which is the when, right? That never changes, just which way we're leaning. What were we leaning on this week? Well, we're leaning on the CPI. That's very clear, which is a macro event, which makes sense going into the Fed meeting, right? All right, so now we understand that. And maybe, do we sell off on the Fed? Nobody knows. They're going to tell you that they know, but newsflash, nobody really knows what's going to happen. We think we know. There are some signs that we are weak on the breath, and we're going to address this. But one thing I do use, well, 2 things I use. One is I look at the cloud, and the Ichimoku cloud right here on this is pretty clear that you're just going flatline. So I am above it, I'm below it, but I'm becoming trendless. So when I see this kind of movement, I tend to pop in the private clouds that I use, and then I get rid of theirs. And I'll take a look and see if I can get more of a trajectory because mine's a little shorter term. and I'm getting some vibe, and I'm not really crazy about the vibe. So I'm green, life is good. I'm buying the dips under the green on the hourly, right? And I'm selling the rallies on when I'm in the gold here, right? That tends to work for me. But you see the change in trend where you're rallying and you have a change, and now that is making those kinds of moves. What I tend to do with this too, or I find value in, is every once in a while I'll just click on that hide, and then I'll just go through this, and what I tend to do is just get rid of like plot, and I also use a 20 EMA, and I'll just look at it and go, okay, am I trending? And if so, how? Well, I was trending, counter trend, trend, and so you were having these levels marked off, and you can actually even chart the cloud, right? It makes sense. Data, that's all it is. It's just different data. And what do you see happening here? Higher high, broke down, now you have a low right here. So then when you're looking at my cloud, right, which, but when you're looking at my cloud, what are you saying? So you're starting to see a change in trend, right? And when you start looking at that change in trend, you might even be able to lie something else over that change in trend and kind of go from there. Here, take a look. So what I'm showing here is that I'm making a higher high here on the hourly, and the RSI is not. Here's another peak on the RSI here, and I'm not doing that as well. And so what this is telling me is that the market is weak, and I'm making highs. Now, we could spend time on the Nasdaq and we could spend time on Bitcoin, but both of those look fairly decent. The Nasdaq's got its volatility going on. I think we have to spend some time on this and look a little bit at the breadth. And let me show you why I think that's important. And then we're gonna get really into it. So for me to look at breadth, the easiest way to look at the breadth for me is just look at the moving average. And I find it very, very telling, and I find it very helpful. And we did something that I didn't want to have happen. And so here's the 5, here's the 20, here's the 50, and here's the 200. So when I look at what I'm seeing is I'm at 23. Now, why is that important? 23% of all stocks in the S&P are currently below their 5-day moving average. That's not great, and it doesn't show breadth of the market lifting. That means that over 70% are below their 5-day. But all these rallies or bounces of those rallies where we're oversold happen when we're at like a 4 or a 5. They don't happen at like a 20. Which means that I have more pain before this would even be a short-term oversold. If I look at the 20, even though the market's going higher, less names are participating and falling under the 20. Now, what's nice about this one is if you took these levels right here, which you can do yourself, and I'm leaving the symbols in here over and over again so you can take them yourself and put them in the trading view. What you note is that if you go and took a look at like the August 5th or September 10th or November 1st, any of these levels you'll see some level of bounce, right? April 15th, anything like that down here in that 23 level. So why we're seeing that 23 level here, what this is telling us down to that 23 level, yeah, we may be a flush and then some kind of bounce. Here's where I get concerned. When I look at the 50-day, and I like having them all in the same chart because it tells me a story, but when I look at what I see is we've broken that 50 level. Now, if you go back and look, once you break that 50 level, there's usually more pain. So if you went back and looked at all these levels going across, every time you broke 50, there was more pain. It might have been for a day or two, it might have been for a week, it might have been for a month, but once you're 50% under, all stocks in the S&P are below their 50-day moving average, you kind of want to put on the brakes a little bit and just let it sort itself out, okay? And that's where my head is right now. Now, that said, on the 200-day moving average, unless we really break that 60% level or even lower, which you have not done all year, gotten down to that level, I don't really need to do anything. But that's more of a long-term indicator, and it's not telling me anything. The signal that I got was here. Now, that said, I'm thinking that this might be a way of them taking off risk and putting risk on after the FOMC on Wednesday. Longer term, we're seeing some really cool developments in the margin side of people borrowing, and I think it's completely misunderstood. So let's get to that. New York Stock Exchange margin debit percentage of growth. Now, what this is showing is the percentage of growth of New York Stock Exchange, all the stocks, margin debt. This is absolutely fascinating to me for a bunch of reasons. And when people see it, they see these extreme moves. But I want to show you the whole data set that they have. So they go all the way back from 52 to where you currently are November. And they do it on a monthly basis. So we're not going to get December until December. But take a look at this. This is why I'm such a nerd for this stuff, because where people just see chaos and just see it random, it's not. When you drill into the data, very telling on should you care about this, should you not care about this. I think you should, and I think you should be paying to these extreme levels, because you can see from 50 on, from 52 on, the majority is just in one area, and then you have these extremes. But do the extremes mean that you need to get out, or do the extremes mean that you need to get in? And I think you need to look at it a little differently, but again, we'd be remiss if you just don't think about it from the standpoint of, okay, the majority of action does happen in here, and you do have these extreme trough levels that do tend to mark bottoms, right? And you do have these extreme valley right down here, and then you have these extreme peaks that tend to mark highs, right? I mean, it's not rocket science. I mean, we all see it. If we went back into this data, we would see that. But let's just take a look at the actual definition of this and what Sentiment Trader actually says that it is. It's always helpful to have the data set and then know exactly what you're looking at instead of me just saying this is what it is. And the reason for that is because then you may find a way to use it that's different. See, data can just be looked at and you can get something else from the data that I might not see. I learned that a long time ago, but when I started to understand how these things were actually calculated, it made my life easier. New York Stock Exchange is the source of the data. They do this on a monthly basis. This is a long-term idea, meaning I'm not looking at this and saying Tuesday we're going to drop or go higher. This indicator shows the 12-month rate of change percentage in margin debt among U.S. investors. Are they increasing their debt or are they decreasing their debt? Now, like most data sets, the devil's in the detail. And the data, to me, is pretty clear. And we're going to zoom in on this in a second. But when you find these peaks and valleys of extreme levels, you're going to get a move. You're going to get a trend change. Why is this important? By understanding these lines and looking at this and saying, okay, for example, here's 20 years and those extreme readings, it tells us a story. Now that story is, do we want to pay attention to the turns? And the answer is absolutely. You most certainly would want to pay attention to these extreme readings. Now the problem with paying attention to these extreme readings is you don't know when you're going to get them because it takes a month for that data to come in. So every turn that you see is a data set. And it doesn't mean that it's going to be that minute where it takes place. For example, when you see the data here and all of a sudden you're like, oh, well, they're getting off margin. If we know it's the New York Stock Exchange and it's margin debt on a percentage of growth, you know it's not just retail. You have to understand that this is also going to be institutional. So they're getting out here. And if you looked at this and said, well, I should be getting out of the market because the next data set peaked, right? You're going to have a problem because if you take a look from there, you're going to miss probably one of the greatest moves. Does that mean that you shouldn't pay attention to it? No. What it means is understand where you are and understand that if they're getting out like this, that maybe we're going to see some kind of correction come down the line. Maybe it's an area of interest, specifically when you're here on a percentage basis. But this percentage basis is relative, and I'll show you what I mean by that. This can get a lot crazier, a lot, and I'll explain why I feel that way. But again, if you see this peak and then you see this trough here, do you act on it? And you'd go, well, maybe you do. Now, this is where I think the data set tells you a lot, because what you're going to note is when people start getting out and reducing. This is where smart money and dumb money and understanding why it's institutional is so important, because they're getting out. And what's retail doing? Retail's just piling in, right? That's why it's important to understand that this is all margin debt, not just retail margin debt. So where's the difference here that you note? The difference is the devil's in the details, because if you look at this, and again, understanding the data makes all the difference. Because if you see this turn at a trough level, you probably put in a bottom. And now you can see why I like looking at this data, because, and again, I could probably draw that. They're nailing the bottom. They are absolutely nailing the bottom in this data. They're not nailing the top. The top takes longer. Why? Because people are just like, they get used to their routine, right? Like every day a turkey goes out and eats and everything's great until Thanksgiving, right? And then that's it, wham. So it's the same exact kind of thing here. And people might think, geez, that's morbid, but that's what happened. You're still months away, minimum, a couple months away from when this peaks of seeing anything. And Are we over and therefore it's done? It depends on the drop. But the data set tells you a lot. So here, let's go through a couple different periods. So if you were looking at this data set and you're looking at it from 03 to 09, and you're like, okay, well, we came out of this correction, blah, blah, blah. Oh, we peaked. And you're saying, well, I don't need to do anything about this. We'll see how it goes. And then the next data comes out and it's here and you're this high. You might be taking a look at that and going, well, we did make a higher high, but they're getting off margin interest, so who's buying? I guarantee you, if we go and take a look at smart money, dumb money, we'll see that retail was buying and institution was probably getting out. And then all of a sudden, we just have that, come to Jesus moment. But take a look at this 2 years later and look at that bottom right here before they start getting involved again. And then it's literally a month later. So you can see that it's literally from that peak, it turns. And the next data point is the bottom of the great financial crisis. I love looking at data sets like this because it tells us so much. And then when you see a period again like this, you can go, oh, okay. And you'll remember, or maybe you won't, when this happened in 22, we actually showed this chart. Now, here we are, and you can see this period of time from 91 down here all the way to 01. We just took a 10-year snapshot, and you can see it from 90 to 01. And what am I showing you? Well, I'm showing a couple things. Because you're over, do you get out of the market? I don't know, only if you want to lose money. No. What you're looking for is you're looking for change in trend, right? So in other words, here's 95. Oh, we're over, so we should be scared. I don't know. If you got scared because of that, what happened? Okay, you lost a lot. So what you would have to do is say, this is one data point and I want to watch the market. Now, when you see extreme readings, that's when you want to pay attention to it. So for me, what would be an extreme reading would be, oh, well, this is a level we've never been to. And so based upon that, I want to pay attention because we've never been here as a percentage of growth. We've never been here this far, this fast. And then what you're doing is you're taking that data and going, yep, we're right there, or we're at that extreme level that we were here and we were here at 1950. It looks like 55 or whatever. But you get where I'm going with this, hopefully. So when we see these extreme, like absolute extreme levels, we have to understand what they're telling us. Well, they're not telling us that there's any powder left, essentially. And it seems to me that it's this 75 level that has happened throughout history. If we just take that line and go, okay, well, you can see here, we know what happened in 80, happened then. But if you see here as well, and then here, okay, so you kind of look at it and go, oh, I got it. And of course, this is the great financial crisis, but you could look at the data set from different ways. But when we seem to be getting into this range, that seems to be where we're having the most trouble. So just because we flipped this line, should we be concerned? I don't feel that way. I'm not saying to just blow it off, but understand where we are. Now watch again when we drill into this. We have the 03-09 data, which clearly shows a top and a bottom. Now, are you going to know that at the time? No, you're not. But it's one data set. What I found interesting was this. I found this one commonality amongst all of them. See this peak where you're hitting a higher high and the margin debt is not going up? That seems to be an issue. When you have these peaks in the market and then you have this extreme drop, it's not like a slight drop, it's an extreme drop in the growth, but at the same time you're seeing this. That seems to be some kind of signal, kind of divergent. Now, you don't really see that here. It's like, oh no, we're out and now we're getting back in. And I think that's what makes this more of a faster trigger to look at versus this, which seems to be a much slower trigger, which could take months to develop as far as forming a top, where the bottoming of this, using this as a data set to make a determination as peaks and valleys, I would suggest that this is a much faster trigger to the downside. See how important it is to understand what you're looking at, because then you can extrapolate it and then make it your own. Most people would just say, oh, well, when it peaks and valleys. No, this is obviously much slower and this is obviously much faster. And here's another great example of this where, okay, well, here's margin interest as a margin debit as a percentage of growth, margin debt as a percentage of growth. I'm on my second couple. And then you can see right here, same exact pattern, right? And now look at how we're holding that area. So now you know where that trough valuation is, right? Where you're like, okay, if we ever get to this level, well, that is pretty much everybody washed out here. And this is like when I really nerd out, because look at the bottom of the great financial crisis and how you're right at that like negative 50 level. See that right there? Look at where you're at right there. Then you come here and you would look at it and go, okay, 7-8 years earlier, right at that 50 level. So we would look at this and go, okay, well, when margin debt growth, percentage of growth gets to around that 50% level, negative 50%, That is a valuation where we normally will form some kind of bottom. And then of course you can see it here, how it turns right around 50 and pushes. Now this time around, we didn't even get there. If you look at the great financial crisis and you look at where we are, we didn't really get that far down, and yet you have the same kind of turn there. And I think that's important. So what we're seeing, and we saw some comments actually, even by the CEO of Interactive Brokers commenting on the margin requirements for names like Bitcoin. And he's right. It's kind of crazy how cheap it is for them to borrow against Bitcoin. But if we look at this level, are we concerned? No, this is where we're at right now. And this is the game that we're playing. What could have been concerning is if we saw a drop in margin interest like you saw here. Then you might say, oh, okay, well, this shouldn't have dropped and therefore we might be getting off. Now, what they're doing is they're getting on the ride. They're not getting off the ride. And we know that the extreme readings are happening well up in this range. They're not happening here. And we know that we're months away from that, from having an extreme reading, right? Before you would even see something like that, it would take literally months to get there, which takes us back to the beginning of this and saying, why do you care if this is a long-term indicator? That's why. So you're not going to act on it. But as we go into 25, if you see something like this, you're going to want to pay attention to that and we'll keep monitoring it. But when you're seeing something like this, you're looking at it going, no, this is pretty much on track. Eventually, we're probably going to get to something like this. Everyone's going to feel giddy, and then we're going to get something like this, and then we'll probably have some kind of pullback. Why I think we could get to here and even a little bit higher is, I'll show you. There's another data set tied to this where they look at it as a percentage of market cap. Now, in front of you is the data set that ties directly to the market cap. New York Stock Exchange margin debt as a percentage of market. What are we noticing here? And this will go back to 52 as well. This is telling you that when those two are correlated, so in other words, not only do you have a peak in the percentage of growth, but you're at highs on New York Stock Exchange margin debt as a percentage of market cap. Could underline that a little bit better. But here's the point. If you're not maxed out here, then that means the underlying assets that they have, meaning these are the assets that they have, okay? And now are they margined heavily on those assets? And that's what's so fascinating about this, because when we were at extreme readings, meaning when we looked at some of these levels like we saw in 80, you can see that was a peak that you never had from 52 on in market cap, meaning if you have $1, if the market's worth $1, then you're maxed out on that. Right? That's your newest, highest level that you've ever borrowed on that dollar. Let's just say the market cap of the New York Stock Exchange was. And then you go to the .com area and you go, okay, well, that was the highest level we've ever had as the New York Stock Exchange margin debt is a percentage of market cap, meaning that dollar is now more levered than it's ever been since back here. But wait, there's more. Here's the great financial crisis. And take a look at this. So every single one, and it would make sense because the market, why it's doing this, is just going up in value. This is actually crazy if you think about it, because you didn't even hit a new high on the S&P. And you were way more levered than you ever were, which does tell us something else. If you ever see this again and you start to correct, run. Because you are way more levered here at almost, well, 1.5 times what you were levered right here for the same price, which is kind of insane when you think about it. This is when people were putting gazebos in their house and then charging an extra $200,000 to sell it right within 30 days. It's crazy. If you look now at what's happening, it's dropping. So people actually are more levered on a percentage basis of growth year over year in putting money in the market. But how much powder is left before they're even at any of these extreme levels again? And I think that's where it gets really interesting, because not only are we seeing the New York Stock Exchange margin debt percentage of market cap dropping, we're watching the growth go up. Well, there's only one way to do that. It means that you're not, even though the growth is increasing, you're not increasing the percentage of margin on what you actually own. The stocks are actually going up. So think about this. The stocks are actually going up faster than you're borrowing money against. I don't see how you peak over that. I can see how you peak over this. So we'll be monitoring both of these. This was a little in depth and it's a longer time frame, but I do get asked to look at some of the longer time frame stuff. So your comments on this are really important to me. I love doing this kind of stuff, but only if you guys see value in it. So please comment below. I think it's fascinating because it tells me, and if you want me to bottom line for it, it tells me that there is a lot more that we could do before we get to any kind of level where we need to be concerned. Now, this is the New York Stock Exchange. This is not what's going on in Bitcoin, crypto, and how they're margining that. That's a completely different conversation for a completely different time if we want to have it. Now, for those of you that trade earnings, This is a really very simple trade and process. And I want to explain it because I'm watching a lot of people buy calls, earnings, and I'm watching them do it wrong. The buy's not wrong, the exit strategy is wrong. So I want to walk through how we did it. I also want to walk through what this was with this little juke down, and we'll talk about that as well. But I want to show you a portion of a trade, and then from there I'm going to show you how we extrapolated that out. And it's not just this trade, but it's how you can do this over and over and over again, and why it's so important. So on this trade, I bought 100, and I did it because of this move, and I'll get into that in a second. But as this was rallying at night, I was hedging these calls. And I don't think a lot of people understand that they can do this. As a matter of fact, I'm convinced a lot of people don't. They can hedge these calls after hours. So when you see this number, that's not what I made because I'm hedging it. People would say, well, you shouldn't have done that. Yeah, I should have, and I'll explain why. When you see this, you're not going to be able to unsee it. And it's something that I think that you should start doing or consider doing if you're buying calls. You can do it on both sides of the trade. I think it's a really important concept for people to get. Now, a lot of people don't get this because for whatever reason, they just don't. But here's the buy, you come in, the earnings are great, earnings drop. What you're doing is you're actually selling something that you own. So in this case, I own the 190. So what I'm doing here is I am selling stock against my call. So in this case, I own the 190. So if we go here and say 190 calls, and then what I'm doing is I'm selling stock against those calls. And I'm doing that after hours. So in this case, I was selling stock in here. I actually did it earlier in here too. We had a trade in here as well after hours, but let me just stick with this. So we're actually selling stock against these calls that we own. This is why it's important to me that when I'm buying options after hours, and you just might want to remember this, I'm trying to buy a delta of 50 or greater. I'm not trying to buy super out gamma squeeze numbers because I want the ability to hedge. Now you could actually gamma hedge after hours, but another video for another time. What we want to focus on is how do I lock this in after hours? And the way to do that is by selling stock against your calls or buying stock against your puts. So as this is going up, what I'm doing is I'm locking in a profit. And I'll show you this on the chart in a second, but let's just say that I'm selling stock at 205. Okay? That's going to equal a pretty decent profit here. So you're going to have 190, okay? And then you would go from 190 to 200 would be 10, add 5, and that's going to get you what? A $15 profit. Now, you don't have to do this. We'll put the little $50 sign. Now, you don't have to do this with all of the trade. What I tend to do with this is I try to hedge as it's going up, and I try to mitigate my risk as it's going up. If it comes back down, takes out a lower low, I might hedge it as well. So when this happens, what I'm doing is I'm doing this over and over again. So as this is moving higher, I'm locking in this gain. It doesn't mean that I have to lock it all in. As a matter of fact, into the morning, I was only 60% hedged, but I had enough of a hedge come on that should this have dropped, then I would have been okay. This is really important to get, guys, because it will save you so much money and so much aggravation after hours that it's absolutely insane. So when I have a gain, like you saw the gain, I'm probably down 55 off that gain just in the hedge. And I'm okay with that because I can keep doing this over and over again. And let me give you another example. So when this is here and we're trading up and I'm like 60% hedged, it pops up again right here early in the morning, like around 7:30. I'm selling stock again. So if I'm 60% hedged here, then by the time I'm here, I think it was like 80% hedged. So as it's going higher, right? As this is going higher, what I'm doing is I'm hedging it. So when I got to this level, that portion of the hedge, for example, is different than this. Now you can average it all together. And that's, again, different story for a different time, but let me just put this up here so you can see it. So what I'm doing here again is going 190. And then at that point I was selling, I think it was 214 is what I got. And I'm just hedging out. Usually how I do it is 10% roughly. It depends on how I see it playing out. But if we look at this again, you would just go, okay, 190, and then you would take the 214, and that 214 is going to take you from 190 to 210, which is going to take you to 20, which is going to say I'm locking in a $24 gain, which is what I'm doing. But what's really important about this is once that's done, it's done. For me, it's in. Now, once I'm locked in like that, I can do a couple different things. I can take the hedge off. I can put the hedge back on. but I've locked in that percentage. This is really important, and you don't have to do it with all of it. Some people won't do it at all, but I think that's a huge mistake because you never know what's going to happen, and I'll give you examples in a second. And when this works, and this is a really good example because it worked exceptionally well, when this happens, you're not sweating this open. All you're doing is taking the hedge off, putting the hedge back on, unwinding the whole trade portion by portion or all at once. You are completely in control. See, these options give you a lot more optionality than you think. And this concept, I can do a whole video on this if you want, but this concept is a game changer. It's been a game changer for people that are in the community because all of a sudden they're not concerned of, oh, am I going to drop down in the beginning of the day? No, it's just a function of this is what we do. We hedge at night. Now, this is my gross lock-in. So for example, what you would have to do is you would have to add for your net profit, you'd have to add in the cost of the option. So for example, if you're here and your cost is $190, and then you would say, okay, well, it cost me $3 to buy that. So then you go, but I covered that percentage at $214, and that's going to get you that $24. But what you'd really have to do is you'd have to take the $3 off of what the call cost, right? So that's going to take you to $211 because what you're doing is taking $24 gain and you're subtracting the $3 from the calls, right? So then that's going to give you a net number that's going to be different, and that's going to be 21. And again, I think this is really important to get, and it can save you a ton of headache in the morning. Does it limit your upside? It's only as much as you hedged, but yes, it absolutely does. But it protects your downside too. If you're trading after hours, let's just say you have 10 calls, make the math simple, and all of a sudden you get this huge push and you make $10, $15. If you hedged a third of that, just make the math simple. Let's say you hedged a third of that when you're up like that. All of a sudden, that entire profit or that gross proceeds is paid for. Now, I'll give you examples of why you would do this and examples of when it can work very well and when it doesn't work very well so that you can kind of see the pitfalls. But going into earnings next year and the extreme volatility we're about to see in the market, this is a concept you want to wrap your noodle around. So real quick, I want to review this and then I want to give you other examples of how this can work and how this can save you. Let's just walk through this. There's the timestamp that we put in the room so that you can see when it went out, and it coincides with, and I said this in the room and I just want to get this out there so people get, when you see news like this where AVGO and Apple comes out, there's some real negative news that comes out, and it comes out the day that you're supposed to see like earnings, you need to be really suspect of that news. This is really just, the old shake and bake, and essentially what they do is they put some article out there. Again, we went over this on Thursday. They put some article out there. It shakes everybody out within 60 seconds or what? Not even. By the time you bounced, you were back up. But, maybe this was 60 seconds, this bar. Maybe this one was. And then that was it. And then they bought. For me, the time to buy, always with this stuff, and you might want to remember this, is once you get above that opening price of where they knew that news was coming out, once they know that, because obviously they know, they're selling right into it, or else why would it move so fast? And then all of a sudden just miraculously stops. Once you close over that level, okay, that's when you get involved. Okay? That's when you get involved. You're looking for things like this, and it's a tell. Okay, it's a tell that somebody's trying to find a way in, and what they're looking for is liquidity. If you look at that price right there on AVGO, and you look at this going through over and over again, you can see exactly how you kept touching that area. It's not rocket science. If you come down here and even look at where AVGO, the first 1 minute bar went to, it went to the exact level of the people that were here. That's not a coincidence. And you can just see the clip from the room, and it's helpful to me for me to show you the actual. So you get to see AVGO, super simple, flip support, and right when we're flipping that level, that's what I'm talking about. The 1 minute stop the whole way, lower low never happened. So we actually did a trade here too we know what this kind of nonsense is. So when we're watching the break, you're seeing the little dojis right here. Once they flip, you make the higher high, it's just on. You're just buying. And then all I was doing for the room and what we were doing is just lower lows, 1 minute lower lows the way up. And then we're watching to see if you're going to flip that right here as well. And then I'm just reminding everybody, a lot of people already know how I feel about this kind of news, that, it's silly news. And then it comes out, just happens to come out that day. They do this kind of stuff, guys, and just be aware of it. But really important concept to get. Let's get to it. Just to recap, you can see where I'm showing where we're hedging, and you can see the timestamps and the price, and how I'm looking at the world where we're hedging, and then where we're getting out when we're doing the live trading. You might want to just screenshot it so then you can kind of overlay and play with it a little bit. Or just watch this part again, because it will show like where you're in from those 190s and then where you're actually selling stock against those calls. Two examples of when this this would have saved you. And one example of this thing just going completely turning into a disaster. So take a look at it. So in front of you is MDB. And again, really important concept. That's why we're spending. If you're in here and let's just say you own the 350s and you're feeling all excited about yourself and you own the 350 calls and you're high-fiving the bros and you're the smartest guy in the room and you're reading this and I knew that they were going to have a good quarter. Did you know the CFO was going to abruptly leave? Nope. So what happens? The CFO leaves, starts coming out. They start answering questions. Doesn't go so well. Now, if you're hedging and you're selling stock against your calls, a couple things. Number one, you're putting yourself in a great position. Why? Because when this drops, you're net short. You could literally be net short on this because all you're going to lose is the price of your calls. So if this just kept dropping, not only are you protected by a portion of the trade, but the entire trade could actually make you money because you could come in and you could just have stayed in it for this entire move. Now, whether or not you do that or you're trimming, that remains to be seen. But this is exactly what happened. So instead of buying calls here, coming in, and then you're here going, oh, well, that's wallpaper, you actually are hedging stock against your calls so that when you come in, you don't care. You do, but you don't because you shorted stock up here and that 50, 60 points is paying for itself. And therefore, a partial hedge, just a partial hedge, would have made you money and covered your calls. This is how you think about this. This is how a professional would trade. And that's what you should be striving for when you're watching these videos. You'd be trying to figure out, how do I get proficient? How do I get better? That's the whole purpose of me going over this. So hopefully you get this concept. If you want me to get more in depth, I can. Let me show you an example of this just being an absolute disaster where it just didn't work at all. And I think that's very important to get. I have calls on Oracle, and I think it's important to state this. They're not all going to work. It's the law of averages. So I buy calls on Oracle, paid $4 and change for them. I come in, it was up for a full minute. I'm reading the report and they go to zero. Okay. This can happen, and that's just part of the game. They are not all going to be monster trades. Some are going to be okay. And the way that I always tell people to think about this concept is you're going to have trades, right? And we all know this, but some are going to work, some are not going to work. But if you think about it going, okay, well, that one I made, 2 times my risk. That one I made 2 times my risk. This one, I lost my risk. Okay, I made 2 times my risk. All right, I made 8 times my risk. I lost. All of a sudden, these outliers that you're getting on the trades, like the AVGOs, are going to pay for themselves. Okay, they're going to just pay for themselves. I can get into the whole money management side of this in another video if it's of interest, but that's how you need to look at this. So try to wrap your noodle around this. Some of them could just be absolute dumpster fires. Some of them could be home runs. What you're trying to do is average out and get on the flip side of 50%. Let's go, because there's a couple names we have to. There are 6 names that had their fate changed, and their fate was changed on Friday at 8 o'clock. Nasdaq 100 made some changes. Let's get into it. PLTR, for example, was added. So PLTR was added to the Nasdaq 100. I don't think anybody, I'm going to give some technical levels here, so you might want to just write, but what you want to do is focus on what's going to happen. When you're added, that means a litany of people have to do what? They have to buy your stock. So they're going to go out there and they're going to buy the stock. They don't have a choice, right? By the 23rd is when this is going to happen. Now, at 8 p.m., the market's closed. You don't even have really overnight trading until Sunday around 8 o'clock. And then you can see 5 o'clock in the morning is when people are going to have the majority of active. Not everybody trades over it. But what's important about this is just your action. You're going to really want to just watch that level right there. Make sure you hold that 75.38, 72.12, 72.15 actually. You can see how some of these levels played out. But when you start getting into it, where can you really go? Well, this is your major level right here. And that level was 7 o'clock in the morning and that 82 level. So you want to see how you're going to act there. And my sense of it is that between that 82, which is up here, obviously, I think you have the potential to get over it. I certainly would think that you're going to at least test that. We'll see what happens, but this is definitely one that is on my radar. Currently, at the time of recording this, we did buy 2 of these 3 names on Friday with the expectation this was going to happen. To me, this was a very simple one to expect to be added. The CEO was out there talking about how he wanted to be treated better from the exchange that he was on. And he said that the Nasdaq he felt was a better fit. So there was obviously a conversation there about them being added should they come over. They moved over. They were added. End of story. I don't think that I really have to worry about this level after hours. But you might want to be aware of them, but I think the bigger levels are really going to be that high where you've tested twice and you have those very strict, very strong doji pillars. I mean, they're so long and you can see the rejection. They're almost like pillars. And then, of course, you're going to have this top that happened on that pre-market, and this was what this was what we refer to as the Druckenmiller high, because you came out and then all of a sudden he's telling people, oh, I'm selling my stock, and then everyone just panicked. Here we are. So let's see how this plays out, but overall I expect this one to have some continued legs. If you look at this on a weekly, and I clean off all my levels here, I mean, it's really hard to not like this name. These kinds of rejections when you're bidding down, if this was red and closed down here, I'd have a little more concerns. Here's why I don't have those concerns. If I just measure that bar from a 50% level, who's in charge of that bar on a weekly basis? Buyers or sellers? Buyers are still in control of that. So 74.39 is another level that I will watch. Number two, this is not one that I played, but a couple of people in the room actually did this one where they thought Axon would be added, and they were right. It did get added. I think this 689.02 level is going to be something to watch. Whenever you have a control bar like this, you want to pay attention to it. The first thing you do with these control bars is just look at the volume and say, is there a lot of volume? Is there not a lot of volume? And you can see that it excelled up here on that. So when you see that kind of excel, not only do you look at that opening price, which you can see all the prices right here, right? You can see that 687.69, and then you come over and then you look at this bar and you look at the close and you see that 687.69 come over to the next one, right? And you can see that open 688 level. Okay, and then come over to this one and look at the close, 660 what? 87.39. See that level right there? 739. That open, take a look over here again, 667.69. Look at the open here of that bar, 687.69. You think there's somebody up here selling? They were selling at the close, they were selling at that open, they were selling there. So over and over and over again, you have a wall here of people. Now, how that plays out with this, I don't know. But I do know that that area is definitely some kind of contention for whatever reason. And based upon that, we're going to want to pay attention to how we act up here, which is a little different than what I think is going to happen here with the next one, which is MicroStrategies. A lot of people were thinking that this one wasn't going to get added even though Polymarket was out there. The way I saw this on a much smaller chart is, I'll show you, post here for a second. And this video is packed. I know, that's why I'm talking fast. But I looked at this as left shoulder, head, right shoulder. You might say this wasn't as developed. I don't know. Not everyone has developed shoulders. So not everybody goes to the gym. You should go to the gym. So if you see how this is set up, people were like, oh, I see another head and shoulders, like here's the left shoulder, here's the head, here's the right shoulder. Maybe either way, no matter how you looked at it, whether you saw the inverse or the head and shoulders, right? And I'm sure you can see it, but I'll mark it off just so, but you should be able to see it, but I'll just draw it. So you could say like, there's the left shoulder, there's the head, there's the right shoulder, and then here's the inverse, right? That's why I love the market. No matter how you look at this, same neckline, right? Not really. Here's my neckline for my inverse head and shoulder, and your neckline's down here for you having the head and shoulders and what's me. So here's the breakout on it right now. And what you want to do is you want to watch this level. That is a bone of contention. The other huge, huge bone of contention has been right here, this peak VWAP. And from that peak VWAP, everything has started. Bonk, 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 complete Matumbo level. Over here, I'm feeling good about myself. I'm a winner. Who's a winner? I am. I knew it was going to stay over peak VWAP. What's it do? Newsflash. Doesn't stay over peak VWAP. Breaks down. And my hopes and dreams. And now we're up after hours. The question is, where do you go? And I think this is where it gets super interesting. So what I would do with this is understand you have tons of players. So we'll drop it to a 15-minute, and then what we'll do is we'll just mark off the peak VWAP here. And what we're going to do is we're going to take these peak levels, right? And then what we're going to do is get rid of that one. I want to put one here. See this extreme move? We're going to put one there. And what you're going to do is you're going to see what I refer to and what a lot of people refer to as the VWAP pinch in here. So between 95 and that 405 level, you have a squeeze. You popped out of that squeeze and you had an equal and opposite reaction out of that squeeze down here a couple days later. But the majority has been since December 11th in between the squeeze of these two levels. This to me is just a wall, right? I would look at this area as massive support now that you're over it. Should you get back into here, think of it as no man's land until it makes a decision again. And this is where people are getting chopped up left and right on option. Okay? You'd be buying the low end and selling the high end if you get trapped in there again. Something to think about, right? Something so you can have a plan on Monday. But you would have to expect some test of 10% or along that on a move like this. The average move with the S&P has been 7 to 8%. You have a level right in here where you opened, tested, held, broke down, retested that level. That 441, you're going to want to get over that and you're going to want to act if you see that starting to break. But if you can get over and hold that, I think that that's in really good shape. There's not much more to say here. This is pretty much exactly what you wanted to see. Now, where they're getting rid of some of these names, and the names that I think are important to talk about, the ones that they're getting rid of, are like mRNA. That's a long way down, guys. And just to be clear, they will sell on the 23rd. So you're going to see people sell the mRNA. They will get out of this. But you have some levels here, and they may have been predicting that it was going to get booted already, right? And you can see. And now if you go and take a look at it, and just remember that it got added back here in June, this right in this level. I think it was June or July they added that sucker, like right in here that got added. And everyone, they kind of broke the rules. Same way they're breaking the rules for to put it into. Down, up 1, 2, 3, down. So I think 35 is where this thing's heading. It's a kind of a one-hit wonder. People get annoyed in the comments and tell me that, it's got this going for it, it's got that going for it. It had one thing going for it, pretty much over it. That growth is kind of gone. And then you can see that 35 level going. Number 2 that I think is worth talking about, and we could talk about Illumina, but I think, so after hours, even though everything is fine, SMCI is trying to raise money through a private equity kind of stake with warrants and everything else, which is extremely dilutive to shareholders. But nothing says things are going fine like diluting shareholders and not having a chief compliance officer, chief financial officer, or chief accounting officer. Nothing screams this is fine like that. News hits after hour. They wait till Friday the 13th at 4 o'clock, and then you can see the rally. People start understanding, and then by 8 p.m. it is dropped by the Nasdaq. Now, of course, I had puts that expired on Friday. Not complaining, I did very well with them, but I would watch this. I think a lot of people that were long and thinking the long end of the game are going to throw in the towel and say, I've had enough. Things are so great and you're making all this money. Why do you need to go out and sell stock? And why do you have to do it through private equity? The only reason to have to juice people like that on the private equity side, right, to buy the warrants, to buy what you're selling, is because nobody wants it and there's that much risk in the product. It seems like they went back to their borrower, Cathay, if you really read the notes, and so far they don't seem to be as interested in the appetite at the level that was offered for more equity in the company. That is it.